Okay, so today we're doing a deep dive into something pretty specific, but really central to the Caribbean economy. We're looking at the banking sector in Trinidad and Tobago.
Right.
And our mission really is to unpack this kind of paradox. You have a sector that stays incredibly profitable, like clockwork, even when the wider national economy isn't exactly booming. How does that work?
Yeah, it's a fascinating setup. And that stability, that paradox you mentioned, it really boils down to the market structure itself. It's a classic oligopoly.
Meaning just a few big players
Yeah,
dominate?
exactly. You've got three main institutions: Republic Financial Holdings, First Citizens Group, and RBC Financial Caribbean. They hold the vast majority of the assets, the influence, everything.
And the history there is interesting too, right? Like First Citizens, that wasn't some organic growth story
Yeah.
initially.
No, not at all. It's actually quite unique. The central bank created it back in '93.
Right.
They basically merged three failing local banks to save them. It was a rescue operation.
A successful one, clearly. But you have to wonder if that origin, that kind of forced consolidation, contributes to why it's so concentrated now. Is that structure ultimately, good for the average person banking there?
Well, that leads into how they stay so consistently profitable. Our sources point to two main engines driving this.
Okay.
First up, high net interest margins.
Which is basically the gap between what they pay you for your deposits and what they charge you to borrow money.
Precisely. And in T&T, that spread tends to be quite wide, quite favorable to the banks.
Okay, so that's one pillar, high margins. What's the other? Because this one, I think, hits people more directly.
Oh, absolutely. It's the fees, the pervasive multi-layered fee structure.
Yeah.
You feel it everywhere.
Yeah. Give us some examples.
Well, think about using an ATM that isn't your bank's, right?
Yeah.
Through the LINX network. That's an office withdrawal. Cost you TT $4 every single time.
Consistent.
And they're designed, really, to shape your behavior. Want to talk to an actual human teller for something simple. At some banks, yeah, that'll cost you. Maybe TT $10, maybe TT $12. They're actively pushing you towards digital channels, penalizing the alternative.
And don't forget the cost if you need to borrow, especially credit cards. Those rates are something else.
They really are. You're typically looking at annual percentage rates, APRs, starting around 24%.
Uh-huh.
But they often go higher. We're talking over 28% in some cases. That's a significant guaranteed income stream.
Okay, so margins and fees explain the internal profit machine. But there's this huge external factor hanging over everything, right?
Yes, we absolutely have to talk about the single biggest constraint, not just on the banks, but on the entire T&T economy. And that's the chronic shortage of foreign exchange.
Specifically, U.S. dollars.
The Forex constraint. Why is it so persistent? What's the root cause?
It ties directly back to the nation's reliance on its energy sector. That sector's been declining.
Mm.
Natural gas production, which is key, has dropped quite a bit. It used to be over 4 billion cubic feet a day. Now it's hovering around 2.7 billion, maybe a bit less. And energy is where most of the country's U.S. dollars come from.
Overwhelmingly. Like over 85% of total Forex earnings. So when energy output falls, the supply of U.S. dollars just tightens across the board.
Which puts the commercial banks in a very powerful position.
Immense power, because they effectively become the gatekeepers for this scarce essential resource. They're not just facilitating transactions, they are allocating the nation's USD supply, based on central bank mandates,
Yeah.
of course, but still.
And what does that mean practically, say, for a business trying to import goods?
It means delays,
Hmm.
significant delays.
Yeah.
We hear reports, particularly from small and medium-sized businesses, SMEs, that they face waits of anywhere from 3 months to 9 months just to get their Forex requests filled.
9 months, wow.
Yeah. Think about trying to run a business, manage suppliers, pay invoices with that kind of uncertainty. It's a major bottleneck.
Yeah.
And it absolutely reinforces the bank's power as the ones controlling access.
So you've got this dual identity almost. On one hand, a sophisticated, well-run, well-capitalized banking sector, very stable.
Absolutely. Resilient.
But on the other hand, a sector whose power and stability are kind of amplified because it manages access to the nation's most critical scarcity foreign exchange.
That sums it up well. The sector's resilience is deeply intertwined with the broader economic vulnerability stemming from that energy dependence.
Right.
And ultimately, looking forward, the bank's future and perhaps the extent of their current power is really tied to whether Trinidad and Tobago can successfully diversify its economy away from that reliance on oil and gas.
Which leaves us with a final thought, something for you, the listener, to consider. How much of the banking sector's undeniable strength and stability is actually built on or derived directly from the economic vulnerability and the structural scarcity that it's currently tasked with managing for the whole country?